Mike, we've got a challenge to the Goldilocks view as well. I just got a message from a Bloomberg subscriber who wants to understand from your perspective. Here's the question on Goldilocks. Does Goldilocks and that view require a pause here from the Fed, or is it inclusive of additional QT and the additional hikes that are likely coming?
Yeah, Jonathan, I think, like I said earlier, if the Fed keeps pushing and tightening financial conditions and gets that funds rate into the fives and continues to do aggressive quantitative tightening, I think the chance of the economy rolling over into a harder landing is significantly higher. I think they could stop right here, continuing to let the balance sheet roll off. I think that's sufficiently tight financial conditions, and I think that would be the best chance of engineering a soft landing. I think what's going to happen is they are going to overhike to 5 or maybe a little bit above 5%, and then they're going to have to cut rates a lot. And that's kind of what's priced into markets. Not this year, but in the out years, the markets are, calling the Fed's bluff and saying you're going to have to get back to 3 pretty quickly and keep it there for a long time. And I think that's probably the right level.
Well, Mike, you're going way beyond this year, way beyond next year. You said this: we're setting bonds up for strong returns in the decade ahead. Mike, why a decade call right now? What's going on?
That's what bond investors do, Jonathan, right? When you buy a 10-year bond, I mean, you're holding it generally for 10 years and looking for that long-term return. Our clients are long-term investors. Your Bloomberg aggregate bond index, Jonathan, 20 years ago yielded about what it yields today. It yielded about 4.5%, which is what it is right now. The subsequent 10 years generated a return just over 5% annualized in a really high-quality, government-heavy index. And we're trying to beat that index as active managers by, 1 or 2% in some cases. So, I mean, you're really setting up, Jonathan, without a doubt, of a really good forward-looking return profile in fixed income.
Does that require, Mike, a return to pre-pandemic growth and inflation numbers?
Not necessarily. I mean, I think if you keep, inflation, like I said, at 3, if it doesn't go back to 2 or 1.5, it stays at 3, and the funds rate stays at 3, and the 10-year stays at 3 3/4, you're clipping this yield, Jonathan. You're clipping this coupon. As Rick Reeder said, there's a lot of value in the markets in really high-quality bonds to earn 6-handle yields. I think the mistake some people make, and Rick kind of implied is you don't want to just hunker down into 1 and 2 year bonds here, right? I think if you do that, yeah, you lock in that 6-handle yield for a year or two, but who knows what the world's going to look like? The funds rate could be back at 1 or 0 in 3 years from now. So you're taking a lot of reinvestment risk by staying short. This is the time to extend duration, lock in this generational high level of yields for the long term.